Hello again. In this video we'll discuss how best to hold your properties and the reasons for the difference in structure. So you can either hold your property in this methodology, which is jointly owned, or you can hold it as in this diagram, which is tenants in common. Now when we first see you and take instructions for your trust arrangements, we have no idea without actually writing to the land registry as to which way your property is held. So if we have to split the property from joint tenancy to tenancy in common, we won't know that until that point, and if that's required there will be an additional small charge of about £100 to deal with that part of the arrangement. But as I say, on inception we've got no idea which way it's held unless you already know. Okay, so why should you hold a property in tenants in common? Well, if your property is held jointly, now in this case we've used a £400,000 example because for some clients with lower value properties this still makes absolute sense, but for most of our clients whose property values far exceed that, this makes complete and total sense. Effectively, the reason you don't want to hold it in joint tenancy is that in the event of when the first person dies, half of the property, if it's held in tenants in common, can be placed into a single settler trust. Now we would only place up to 325,000 of a value of the property. So if the property exceeds 650, then obviously the 325 would take up your entire allowance for inheritance tax purposes, and the remaining part of the property would be passed to your wife either via the IPD, which is the immediate post-death interest trust, or directly to your wife, whichever depends on the circumstances, and we would explain that in your personalized advice. But mainly the reasons is that if you jointly own a property, although on death half of that property is still allocated on your probate forms for the value of the estate, because in most wills it transfer that value to the surviving spouse. There's no inheritance tax implication at all because it's just a transfer of assets between husband and wife. But because it's jointly owned, it predetermines who's going to get the property. It wouldn't allow any part of the property to go anywhere else other than the surviving spouse, or all to somebody else, because it isn't split, right? Whereas if you split the property, as we would suggest, 50-50 usually, sometimes not, depends, but usually 50-50, half the property can go into a trust. Now this means that after the first death, the advantage of this is that if we can presume that property grows at around 4% a year, and the value of your £325,000 allowance, which has actually been frozen for about 9 years already, only increases at about 1.5% to 2%. Obviously, if there's, let's say, 325,000 of value in that trust growing at 4%, it's going to exceed the rate of the allowance growing at 2%. Therefore, because it's in the trust, not in the surviving spouse's estate, it means that that value grows outside of the estate and has an inheritance tax saving. And we've calculated for the majority of our clients, usually within a year, sometimes a year and a half to 2 years, this particular methodology of saving tax is not huge, but it'll save at least the cost of setting up this planning, and therefore it's a very effective method of saving some additional tax. Now also at this precise moment there is another potentially much bigger saving, which says that if half the property is owned by a trust and the other half by the surviving spouse, on the second death, because the property is owned by two separate legal people, the trust on the one hand and the surviving spouse on the other hand, this means that there is a deduction on the whole value of the house for inheritance tax purposes at round about 17%. Now if your property is going to be worth, whenever you die, let's say close on to £1 million, 17% of £1 million in inheritance tax saved is a very nice little tax saving. Thank you very much. and therefore this planning is definitely worth doing, and the extra little cost of splitting it into a tenants in common is certainly worth doing, and that's why it's a standard recommendation across the board for all clients. So that's the separation of assets and splitting the house.